Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Allison Ankerstar, and today we'll hear Steve's end of year message, a review of 2022's market performance, and a few items for your January financial checklist. But before we begin, as a reminder, this financial education presentation should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. 2022 comes to a close tomorrow. What are some of the reflections of the year?
Well, hey, good morning, Allison, and welcome everybody. Our last show of the year, and what a year it has been, and not in a good way, right? Normally, ever since we've been in this business here for going on 8 years now, the end of the year recap is the exciting new highs in the market and the book. All kinds of goals met across the board, and that's just not the case this year. But what I do want to say is captured here on this slide is thank you. This is a journey. Your investing journey is going to have ups and downs, and this was one of the down years. And the only thing I can guarantee is you're going to have a few more of these in your lifetime. The good news is that they are rare, and that you survive them. The bounce back is generally, the market's undefeated on its way to bounce back to new highs. It does take some time, but we'll talk about that a little bit when we get into the performance numbers. But I want to say thank you, first of all, for your trust. You could choose to have anyone manage your money, or you could choose to manage it yourself. But thank you for trusting the team here for our expertise and taking care of you. Thank you for your patience, because it's not easy. We're here for the phone calls, the complaining, the expressing your frustration as to why the market is doing what it's doing, why the Fed is doing what it's doing. All those sorts of things. We're here to answer your questions, to put you at ease that yes, this too shall pass, and we'll be on to bluer skies in the future as far as you will. And last, thanks for your friendship. Obviously, we're building a relationship here. This is a relationship-based venture, if you will, and it's a journey. So hopefully, even though the numbers weren't looking good, hopefully you're satisfied with the performance of our team and taking care of you, administratively, and helping you kind of sort through your mind what your relationship with money and what you're trying to do as far as your financial goals. So thank you to the clients for being a part of this experience. Thanks to the team. Obviously, we've been building out the team significantly over the past 2 years. Candace is the cornerstone of the organization here. Pretty much everything we do is, Candace is quarterbacking that as the operations manager. So a huge thanks to her, not only for taking care of everyone behind the scenes, but also helping me clarify my thoughts as far as some of the things we've done for building out the business. Standing up a 401k for the first year, the hiring and the training programs and all the registration requirements that we're going through. Just an invaluable asset to the team. So thank you, Candace, for everything. For the advisors and for Allie, welcome aboard. It's been kind of a crazy year. Thank you for your ideas, your energy, your focus on trying to make the place better as we continue to grow. The slide has 6 people on it. It's only going to have more faces at the end of each year. As we continue to grow and we continue to build out. We're always thinking at the long term, and we're, as far as how to build the organization out to take care of as many people as possible. And that, in the underlying effort is, again, that rapid response to client concerns, getting you an answer to your questions and inside of a 24-hour cycle. And then always the underlying culture is take care of do it for the people, not for the money. So it's all, again, focused on taking care of you, the listener, and client out there. So thanks again, everybody. I really appreciate that. It's a tough year, and we'll talk more about performance here in a second.
Next, 2022 is the worst year for the market since 2008. How bad was it, and what does that mean for 2023?
How bad was it, Allie? I don't know. It's pretty dang bad is what it was, is the official, and it's getting worse today, right? So were we going to go out with a whimper or a bang for the last trading day of 2022? And it appears it will be a whimper. This is a live shot. We're 32 minutes into the market open. And generally, these things don't reverse. So I don't expect really any recovery or change throughout the end of the day here. And again, a lot of people aren't working as far as the what I call big finance world, if you will, New York City crowd and stuff. So overall, I think we're going to be, down even worse than these numbers project, but it is the worst year than 2008. So think of where you were in 2008 is, to keep your long-term perspective. You think of where you were. Are you better off now? Yeah, we had a bad year in 2008, then we ripped higher for what, 14 years, if my math is right. So it takes the down years to get the good years going again. Even it rains in paradise too, right? It's part of the it's part of what everything needs to be the full circle there. So here's your numbers going into today. 33% on the NASDAQ, and especially when you're a money manager that believes significantly in the long-term returns of tech, like I am, then you're going to end up taking the full ride of the roller coaster here. Obviously, we implemented our bear market strategy, meaning all year long it was a flight to quality and basically holding those quality names. And I know it's tough to say Amazon's quality when it's down 50%, but it is. I'm a buyer here. But overall, you can see that we may end up close to 35% down on the year for the NASDAQ. As far as the yellow line, that's the S&P. That's going to be around 20%, and then the Dow may end up around 10% down for the year, but pretty heinous across the board. We've invested in a lot of different investments we don't normally use this year, including CDs and a lot of short-term treasury funds. We used buffer for the first time this year, as well as King, a dividend fund. Again, try to get reduce that risk and reduce the losses. So hopefully, as you look at your portfolio over the year, you're not looking at these type of numbers. You're looking at less. The ones that are really down the most are the ones that have the super aggressive funds, and that's part of it, right? If you stay long and strong and don't hedge, and then of course you're going to pretty much taking the full ride. The good news is you also get the full ride back to the upside. I did want to say though, so you're like, okay, you can't look backwards, you have to look forwards. And what are some of the numbers going forward? Well, I got these off of CNBC this morning. Anytime there's any down year, let alone a kind of heinous down year that we're having now, anytime there is a down year, and they have the numbers of how many we've had, the average return the next year was 14.2%, and the market was up 81% of the time. Yes, are there challenges in 2023? Yes. The narrative largely remains the same for 2023 as we still have an inflation problem, and we have the Fed raising rates to solve it, which may be, the cure worse than the disease. We still have the Russia-Ukraine conflict raging on. So, not much of a change to be the catalyst to drive things higher for 2023 right away. Eventually, the Fed will pause and or pivot. We don't know that yet, but certainly if we can stabilize the rates from going higher, then we can start to build that market that, again, now builds on known cost of money, if you will, and can go higher as well. So overall, rough year, and we're going to put this one in the books today, and we're going to start focusing on 2023 and our game plan.
Last, what should people be focusing on financially in January?
Well, the Christmas season, first of all, theoretically, the Christmas season is a high spend season, right? Everybody wants to take care of everybody else and show your appreciation and gratitude, or spoil folks, whatever your particular reason is, you give gifts, but it's a very positive time. I know the holidays can be tough for some, but for most, it's a positive time of family and friends and gift giving. That can come at a high financial toll. So it's probably, if you haven't done it yet, it's probably time to, log into the credit cards and kind of see, okay, what was the damage here? If you haven't looked, because, damage isn't going to go away. So take a look at where you are financially, make sure you get all that stuff paid off if you have the ability to do so. If not, of course, make a plan to pay it off there. So that's kind of the debt and management part of it. A couple other things. If you're due for a raise, or if you got a big raise, or if you're tied to inflation, if your salary is tied to inflation type index, almost 9%, if you will, of a raise there. So you may have to go in and adjust your W-2, which is your tax withholding. So boring, yes, steps for January, but look at the debt you accrued over Christmas. If you accrued any, take care of it. Adjust your W-4, which maybe increase your tax holdings, withholding, excuse me, on a monthly basis. Again, do that with your employer. Those are kind of the two basics. But really, you want to take a look at your IRA game plan. And I have Investopedia pulled up here, 4 basic facts. The maximums change. So if you're in a position, depending where you are on the spectrum, right? If you are not investing in IRA, then you need to educate yourself or listen to us about traditional versus Roth and the benefits and get started. If you're at the get started phase, you want to do 50 a month if you can, and then try to build that over time. You don't have to wait until you can do the whole amount, right? So you start with something, and then that way that develops those habit patterns, and from there you can look to increase the amounts. That's the best way to do that because it gets things in motion. But really, most of the folks out here that, again, we deal with are in a position to where they are maxing it out over a year. So as a reminder, 6,500 is the new max for the regular IRA. If you're below 50, or if you're 50 and older, that moves to 7,500. Really, the decision you need to make on your January checklist: are you going to dollar cost average on an annual basis, i.e., make a lump sum in January, or are you going to dollar cost average over a monthly basis? Those are kind of the two basic strategies that are out there. Especially coming off a down year, when things are as down as much as they are, I would lean more towards the lump sum, i.e., fund it in January and get it out of the way. And then if you do, so 6,500 and 7,500 if you're over 50. If you have that ability, again, you can do, even if only one of you works, you can do a non-working spouse IRA, so both of you get to contribute. So a spouse is never penalized for not working. So you can max out both those in January, and obviously you haven't made the money yet. But as the course of a year, if at least one of you is still working, you're going to make enough to be able to max this out. When you take it in terms of monthly, or if you're set up with us right now or through whoever, if you're set up on a monthly basis, you now need to change your numbers, right? Because the max has changed. So for the 6,500, you want to 541.66 is what you want to set your monthly up to. It does automatically round up to 67. However, if you do an extra penny a month, you will at the end of the year be 3 or 4 pennies over the max. Do not do that. So round down, right? Rarely in life do we round down. This is one time to round down. So 541.66 is what you want. And then at the end of the year, if you want to put in 8 cents and make up the difference, you can. Or you call it good. The 7,500, again, if you're 50 and up like I am, you can put in $625 a month, and again, that will get you done as far as the max. As far as so that's your personal IRA situation. So take a look at that as part of your January checklist. The next part is to look at your 401k situation with your employer. Hopefully you have one. You can max it out to 22,500 is the new max if you're below 50. So again, that works out to $1,875 a month. So you want to set that up, take care of it now, because if you wake up, if you're like, okay, all of a sudden it ends up on the April checklist, you may end up having to save a ton out of your paycheck to be able to hit those maxes. Again, not everybody maxes these, so don't feel bad if you don't. Do what you can, try to increase it over time. But if you're in a position where you can max it, then realize it's a pretty significant chunk of change now that these numbers have gone higher. If you're 50 and older, that new number is 30,000 now for the year, which works out to 2,500 a month. So yeah, you got to have a pretty significant income to be able to carve out 2,500 a month. But take a look at your own situation and just make some decisions there. But January is the time for that versus waiting. And I'll close with this: is that a recession is predicted. We'll see. I think the Fed has done a great job of forecasting what it's doing. I think it's forecasting another 25 basis point rate hike here in January, maybe 50 basis point and then 25 and then hold. But I do think the rate hikes are going to stop somewhere in the first half of 2023, and then a recession, if we have one, which we probably will, by definition anyway. Then just beware that if you're saving all this money in your 401k or into IRAs, now it's there might be time to, if your cash flow is a little thin, then I would lean more towards the conservative side of keeping some extra cash around versus maxing everything out and being cash poor, right? So caveat your own personal situation with where you are. If you can max out your stuff, great. If you want to be a little more conservative, don't max it out. And then once things start getting better towards the end of the year, then you can try to go back and catch it up. So if you want to talk that over, please reach out and contact me. But that's what I have for your January checklist. And I will close with enjoy New Year's Eve. Be safe out there and reflect on the year and get excited about your plan for next year.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here in the new year.